Coming up on today's show, stocks finished the day mixed, David Einhorn's latest warning, Bitcoin falls below 40,000, Spirit Airlines rips again, the odds of the Trump election win, and with the Chinese government stepping into its stock market, we're going to take a look at whether Chinese stocks have bottomed and is it time to buy. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. Thanks for tuning in with me today. I've got an interesting one for you with everything that's going on in China, and we're getting into the thick of Q4 earnings season. We just had Netflix report and blew past expectations. We're up big after hours, and it was quite a mixed bag out there to finish this Tuesday session on Wall Street. Once again led by mega cap tech, and we saw some big pop-ups in Verizon, Procter & Gamble, and a few other names, all of which I'll get into on the charts. But the big one we'll be looking at today are the most popular and liquid Chinese ETFs and stocks. We had some big moves up today on the news that the Chinese government looks to be stepping into the stock market with a huge stimulus program. Something I've been talking about on this channel for a few weeks now that they were likely to do. And just like I said on Friday afternoon, Alibaba under $70 is good value. We ripped up almost 8% today, back above the 50-day VWAP. But stick with me, because after we go through the main US indices, will come back and take a look at everything that's going on in China. There's a look at the S&P 500 just finishing slightly higher today, but it was the Magnificent 7 here. Once again driving the market, collectively up over 0.5%, but a little bit of weakness in the mid caps and small caps with the Russell 2000 finishing down. And you may have noticed I've just updated my signature custom indicator buy-sell bands, just releasing the latest version 3 that you can see on the charts here, proving the visualizations of them. And for those of you who have already got a copy of my buy-sell bands, just restart your trading view and it'll automatically update, and they'll now look like this. And if you don't already and you'd like to get access to my buy-sell bands custom indicator for TradingView, then just head on over to my website, clickcapital.io, click on the indicators page, and then scroll down and you'll see the buy-sell bands indicator, which you can purchase for a one-time fee of $49. That's with no ongoing costs. And there's a look at NVDA, which got up to above $600 a share yesterday, just finished slightly lower. Another chart we'll be looking at today is Tesla. We've got earnings coming out tomorrow. It's trying to hold the line here around 205. And stick with me, because after we go through all the news, we'll come back and dive into the charts, and I'll show you some other interesting things that I've found out there that I want to present to you. So I've been on a good multi-month rally in the S&P 500 here. Did start the year a little soft, but we appear to have come back, although it is a pretty skinny rally year to date. Over half of the S&P 500's gains have pretty much come from just a couple of stocks at the top. However, we've still got big companies like UBS saying the rally in stocks still has room to run after we just recently broke out to new all-time highs on the S&P 500. So even though the price action in stocks is really good, we're breaking out. We do have quite some divergent indicators out there, especially in the macro, with leading indicators falling again. And we now have a really long streak of monthly decline in the economic leading indicators, now coming in at 21 months. Only two previous instances that were higher than that was back in 73, 74 and 07, 08, both of which times we had nasty recessions closely following. Also got the inventor of the inverted yield curve indicator, confident that it is calling for a slowdown this year like it normally does every single time. And even though unemployment is low, we still have a lot of consumers in a tight spot, credit cards maxed, credit applications denied, struggling with the cost of living. But we've got most on Wall Street really optimistic. And that's why there's a bit of a divide between Wall Street and Main Street. We even got famous billionaire hedge fund manager David Einhorn warning of a bubble level hype around the hottest stocks, and he's betting on defense stocks to benefit from foreign conflicts. Going on to say bubble-like conditions returned for the most speculative stocks, and a handful of our shorts went parabolic. And so there's a look at the monthly chart of the Nasdaq 100 ETF QQQ, which this month has broken out again to new all-time highs. And that's thanks to the leading sector in the market, semiconductors, which have performed even better than the Nasdaq over the last 5-10 years. However, the second biggest economy in the world and their stock market is a much different picture, and that's China, which we can see here in the most popular ETF, FXI, Chinese large cap stocks, still well down off their 2007 highs, even though in that time their GDP has grown from 3.5 trillion up to almost 18 trillion. And we've seen a big increase in GDP per capita as well, grown from 2,694 up to 12,720. So the country's got a lot richer in that time. Their stock market has just completely diverged from their economic growth. And as I've been forecasting for the last couple of weeks, the Chinese government is recognizing that and wants to put a floor in it, because they know their economic prosperity and the number one mandate of their government's social stability is going to be correlated to the performance of their stock market, and they want to prevent a big crash because they don't want to see people out in the street protesting, having lost all their savings in the stock market. And that's why we're seeing reports that Beijing is about to step in with a big $300 billion package to go straight into the stock market. And this is after a series of other interventions they've done, like banning short selling and big brokers from selling. And so the tide could be turning on Chinese stocks, which have been beaten down really hard, in particular the last couple of years, ever since COVID and kind of their failed reopening to really stimulate growth. Economy's still growing at over 5%. It's a bit less than what they're used to, but we're starting to see some big inflows. Here's a chart for the daily net inflows for 5 of China's largest ETFs. Breaking out on the news, the country's top government body met on Monday with the number 2 man after Xi, Premier Li Qiang, urging stronger and more effective measures to stabilize markets and boost confidence. And in another sign of capitulation, this is on the back of news of a liquidation of a sizable fund coming out of Singapore. Genesis closing down after they went long China and short Japan. Trade they had on for a while. Lost almost 19% in the first few weeks this year, and the fund closed down over 60%. And if you look back through market history, typically when we see these things, funds blowing up, it's a good sign that we're near the low or the top. One of the most famous coming to mind was Julian Robinson of Tiger Global Hedge Fund, who was short tech stocks in the late 90s. Blew up billions, closed down his hedge fund just months prior to the top was put in. And beaten down more than Chinese stocks is that of Hong Kong stocks. Become a bit disattached from the mainland. We've even got things like India's stock market overtaking Hong Kong now, becoming the 4th largest market in the world. But the pessimism hasn't gone away just yet. We've still got a lot of people saying investors should continue to steer clear of Chinese stocks. With one research analyst saying, bottom line, Chinese stocks have been hit by a series of mostly self-inflicted wounds from a policy standpoint, and until there's evidence that authorities are committed to stimulating growth or reducing regulatory interference, we should expect continued pressure on Chinese stocks. However, you got to remember it's always darkest just before dawn. By the time you wait for everything to be perfect, it's already too late. Reminds me of a saying from Buffett, by the time you hear the robins, spring has already arrived. And just looking at the Schiller PE, that's the 10-year PE ratio for the China 300 index. It's at a really low 13, implying an earnings yield of around 7.6%. Just to put that in context, the US 10-year PE is at 32, better long-term earnings yield of 3%. And just looking at Buffett's favorite valuation indicator for the market as a whole, looking at total market cap versus GDP, China's currently coming in at 50%. And looking back in history, the expected future annual returns from that's just under 12%. Comparing that to the States, current market cap to GDP at 177%. Again, using historical patterns, the US stock market could return less than 1% per year over the coming decade. And even though it's the most hated trade out there, investors big and small have bailed on China, especially in the last couple of months. Something that's been going on for a few years. I'm not the only one that sees long-term value there, even if it's just a medium-term reversion to the mean. We've got Alibaba co-founders buying more than 200 million worth of shares in recent times. That's Jack Ma, who started the internet giant, getting back into the stock. He obviously sees value there, along with his co-founder, Joe. Okay, get into the charts of Chinese ETFs and stocks. Here's the big one, FXI in the daily. And so we've got a big bounce here on volume. 103 million units traded today. That's huge, up 4.5%. Hong Kong as well, up 2.8%. And then the Chinese ETF KWEB, up 4.9%. Just going through some of the biggest stocks, Tencent, Alibaba, the best performer out of the group today. Li Auto, their big search engine, Google equivalent Baidu, and JD.com. Just heading over to the monthly charts, we could be setting up a double bottom here on the FXI. And this is after we're down a massive 59% from that high we put in February 2021. Same deal with Hong Kong on the monthly chart. Getting some rare reversal signals from my indicator here. 3rd in the row. That's really rare for a country's stock market on the monthly chart. We did have one here before that kind of failed. However, before that, the last time we got some bullish reversal signals on the monthly chart was in October 2001, which we did retest back in early 03. However, those levels were the bottom before the Chinese stock market went on a huge rip into late 2007. And just to put it in context, to show you some other monthly charts of other country indices where my bullish reversal signals have occurred, there's America in early 2009, that was the bottom. Same with United Kingdom, the only time we got the bullish signals. There's Switzerland in late 22. Looking at Italy, every time we got my bullish reversal signals on the monthly, marked a bottom. Did a pretty good job on the Germany index. Nailed the lows on France, and the same with Japan. So my point is, on the monthly chart, especially on Hong Kong stocks here, these 3 bullish signals in a row is very strong. They're even stronger than the bearish signals. And one area that I'm actually got as one of my top 10 picks this year is Chinese small cap ETF, ECNS. And we're getting 3 bullish reversal signals on the monthly chart here as well. And this ETF is still down a huge 66% since those highs in early 21. And just going down to a weekly chart on the Chinese large cap FXI, we could be putting in a pretty big double bottom here from those October 2022 lows. And you can see we're getting a bit of a divergence on my DSI indicator as well, and reversal signals on the weekly chart. So long story short, technically, fundamentally, Chinese stocks are very cheap here. Of course, it's not without risks. Of course, that we could get a bounce before we come back and retest. It could be a messy bottom before we do get that reversion to the mean. Not saying everything's going to be okay with the Chinese stock market. It's going to overtake America anytime soon. Still think they've got a lot of long-term problems, especially from the top down. However, even just like I said, for a medium-term reversion to the mean play, you can get some really good gains coming off these lows, and potentially being at a technical bottom, we could do that with a low risk reward, with a stop below it. If I was to look at kind of like a technical fair value, say drawing a volume profile from the last low in October 22 to where we are now, we can see that point of control is around 27.89 on the FXI. So if we were to look at a potential trade setup here, we could get long here, put our stop a wee bit below where we are now, let's say give it at least 10%, 11% there. Bit of wiggle room, bit of retest, and then we put our target just below that point of control. That still gives us a risk to reward ratio of 2.3. So looking to make $2.30 for every buck we risk. And like I said, that could be a medium term play that could play out this year or over the next 18 months. And so technically and fundamentally speaking, China could be an attractive setup here. And even more so on Alibaba, looking at a long-term chart, significantly undervalued. It's below its 2014 IPO price. Back then it had annual revenue of $8 billion. Here we are today, annual revenue $125 billion. And so if we were to get any sort of medium long-term retracement of this move, just drawing a Fibonacci from that top down to the bottom here, just a 50% retracement would take us up to 189. And once again, just drawing up another potential trade of long Alibaba, if we gave it a bit of wiggle room, say below this support zone, about 26% of wiggle room and risk, target back up to that 50% retracement from the move down from the all-time high. That's a huge risk to reward of 5.8. And that's why I think it's an asymmetrical bet. Of course, it could be messy, take some time. It's not without risk. I just think there's more upside than downside in China. It's a huge contrarian play because it's so hated here. Not to mention just a huge divergence between price and value, especially relatively speaking around the world. However, for now, I'm going to stick with my Chinese small cap bet on the ETF ECNS. It's got a dividend yield of 5.7%. It's only got 49 million in assets under management, which means Wall Street is not in on this. If it does come back, we could get a wild bounce as people rush back into it, and I still think we've got a good chance that could happen this year. So I guess we'll just have to wait and see what happens. But if you haven't already, hit that subscribe button to this channel, Click Capital, and I'll keep you updated on everything that happens with the Chinese trade going forward. Moving on, we've got long-dated Treasury yields breaking out again ahead of some GDP and inflation data due out later this week. That's on Thursday, which will get an early reading on fourth quarter US GDP growth. It's expected to come in at an annual pace of 2%, down from the 4.9% rate in the third quarter. Then on Friday, we've got Fed's preferred inflation gauge, Personal Consumption Expenditures Index, PCE. That should get rates moving again. We've had a bit of a repricing the last couple of weeks in the Fed Fund Futures market. Not even 2 weeks ago, they were saying 80% chance they were going to cut in March. Now it's looking more likely like they're not going to cut until May. That's because we've had a little bit of a bump up in CPI. Jobs market's still tight. Retail sales coming in higher than expected. The Fed can just hold off a little bit longer here. There's a look at the 2-year yield, holding ground at 4.37. The long-dated stuff doing a bit better with the 10-year at 4.13 and the 30-year at 4.36. Let's not forget we've got the 30-year, 2-year yield curve just recently getting back above neutral territory. That's typically a sign that a recession is not too far away. However, we've still got the 10-year, 2-year, a little bit more work to do before it gets back into neutral. And there's a look at TLT, the 20-year Treasury bond ETF. Still below the 50-day VWAP here, finishing lower again today. And looks like we're doing a bit of retracement off this move, off the October low here, after we put in that huge volume and then did a big rip right up. We'll be looking for it to find support kind of around that golden pocket, which will be around $90 a unit. Also getting down to the bottom buy-sell band. Something we could see if yields keep moving up over the next week, especially if we get a hot GDP and PCE print. That should see TLT back down into the low 90s. Moving on, commodities. We've still got oil a little soft here after it's been holding up pretty good this year with what's happening over in the Red Sea. Market's still flush with supply. Haven't had any real new developments coming out of the Middle East over the last couple of days. There's a look at the daily chart. Crude oil futures still coiling up just above the 50-day VWAP here. One could say we just broken out out of this triangle formation that's been going on for a while. If we were to see any new conflicts coming out of the Red Sea, then we could be going back above $80 a barrel. That's going to keep the upside pressure on inflation and yields. It'll be interesting to see how the stock market reacts to that if we get that. Just looking at gold, still soft here. Seems forever going sideways just below its all-time highs that we reached back in early December. But again, if we were to get any new conflicts coming out of the Middle East, then that's going to be ripping up as well. Moving on to crypto, all these new ETF investors and the new Bitcoin ETFs aren't feeling so good. We've got Bitcoin losing key psychological level of $40,000 a coin. There's the performance since they launched. Looking at Bitcoin itself, down 15%. Coinbase almost there as well. And so was this key event in markets a sell the news, or is it the start of something new, or is it the ultimate exit liquidity for Bitcoin whales to sell into all these ETFs that have to buy the underlying, of which they're already approaching $1.5 billion in assets under management just after a week of launching them? Still a really strong bullish consensus in the community, with some people saying we're guaranteed to hit $100,000 a coin this year. As a look at the daily chart on Bitcoin, looks like we're just breaking down a bit here and have lost this upside momentum we've had for a few months now. And just taking you out to a monthly chart, that's not looking too good there. Looking like a bit of a shooting star, which could potentially be a bit of a topping process here. And just doing a little Fibonacci from the all-time highs to those lows we got in late 21. Once again, it looks like it may have stalled in this golden pocket Fibonacci zone. And so if Bitcoin were to keep falling from here and continue rejecting off this $45,000 level, technically speaking, that is not a good sign. There's a look at the largest Bitcoin ETF trust. Already got $1.4 billion in assets under management. That's just been updated and continues to grow. However, from its all-time highs that it reached in the first hour of trading, it is down over 25%. We've also got Coinbase falling since the ETFs launched onto the market. Could be getting a little technically oversold here in the short term. My institutional buying percentage indicator getting pretty high at 66. DSI oversold, got some reversal signals. We may get a little bounce here. However, it all depends on Bitcoin itself. Got the big one this week, Tesla earnings out tomorrow. Got a lot of negativity in EVs. Got some industry insiders saying the market's oversupplied. Had some pullbacks and big fleet owners like Hertz. Not really convenient for their rental customers to do all this charging. Industry still has a bit of a ways to go, and Tesla has been the weakest Magnificent 7 stock, especially this year. So we'll get their earnings after close. Street really be looking at their profit margins as they've been cutting prices around the world to try and keep up demand. Had the price of Tesla used vehicles dive over the last year. However, they're still keeping up their deliveries. Last quarter, they produced 430,000 cars and delivered 435,000. That was a record. Got Goldman Sachs saying key downsides to our view relate to potentially larger vehicle price reductions than we expect, increased competition in EVs, delays with products capabilities like FSD, the third generation platform. And so there's always been a struggle in Tesla stock over the last couple of years. Should it be priced like an automaker, in which case it should be less than half the price it is at now? Or is it priced like a clean energy company of the future, for which their sales outside of EVs still make up a small portion, something like less than 12% of their revenue? However, you've got to remember with Tesla, it's almost like a cult. A lot of people love buying and hodling. They're excited by full self-driving, robotics, solar, home energy, the things like that. Things of the future is what help keeps its lofty valuation. However, that could be under threat if the margins and profits from their EV business, which helps finance everything else they're doing, continues to suppress. So there's a look at the daily going into earnings tomorrow, and we'll be looking whether we can hold this kind of support it's been finding around 208, or if we get some negative surprises, we may actually just go diving right through that. However, it's earnings. Nobody really knows. We could get a big bounce either way. And there's a look at the monthly chart. Has been coiling up for a while now, and one could make an argument that we're in the process of a head and shoulders formation that's been going on for quite a few years now, especially if we get a downturn from here. And at 664 billion market cap, if that were to come back in line with the rest of the auto industry, then Tesla still could trade below $100 a share over the next year or two. Because looking at General Motors, which still has almost double the annual sales of Tesla, has a market cap more than 90% lower at 48 billion. Same deal with Ford, 45 billion market cap, almost double Tesla's sales. So it's all about perception. Just like we've seen with Chinese stocks, market prices can become really disconnected with the underlying numbers that they're based on. That's why when you buy a stock, you're not just projecting the company's sales and cash flows, you're also projecting an investor's perceptions of those cash flows. Also got a bit of meme mania coming back to the market. Spirit Airlines ripping up again. Got a lot of retail traders, call options going. And that was after last week's blocked merger from a federal judge with JetBlue. They're fighting back and appealing it. A lot of people getting behind it. Still a fluid, unfolding situation that hasn't really been decided yet. Even got Dave Portnoy from Barstool Sports buying shares and pumping it up on Twitter. There's a look at the daily chart here today. We actually rallied above $9 a share, just taking it down to a 5-minute chart. Ripped up there in early morning trade, however, just fell over and just holding ground here above $8 a share and just taking it out to a monthly. It too is well off its highs with a market cap less than $1 billion. So we'll keep an eye on this one going forward, see how that unfolds. Probably the biggest event on the calendar this year is the US presidential election in November. With Trump making a strong comeback, looks like he's wiping the slate on the Republican primaries. Wall Street's already gearing up for what that's going to look like. And just looking at bookmakers, which typically do a really good job at pricing the future, actually got Trump leading Biden now at 46% chance he's going to win. Biden at 36% chance. However, there's still a long time between now and November. Anything can happen, and the bookmakers aren't always right. I remember watching the odds on the last election night. Trump was pretty much a shoo-in right till the end when a lot of mail-in votes came in over the next couple of days and changed things quite a lot. We may see the same thing again, who knows. Either way, it could get spicy, could get markets moving, and so we'll be following this a lot more closely as we approach that date. So looking at economic data today, we didn't get much out from the States. Got a bunch of PMIs coming out from the Eurozone tomorrow, along with the States. Canada's interest rate decision. Then Thursday, we'll be getting that GDP data, some durable goods. We'll get to hear from the ECB on how they're feeling about inflation and rates, along with jobless claims, and then the PCE data to get a read on inflation, finish the week out. Fear and greed index still sitting pretty at 73. Corporate insiders taking a nap, not interested in trading this market at all. So looking at liquid stocks and ETFs making 52-week highs, 313 today. The biggest one, Verizon, ripping up on earnings. We got Snowflake, big bump up in Trump's SPAC Digital World acquisition, and a bit of a mixed bag for the rest. So looking at 52-week lows, 38 stocks and ETFs today, with nothing really noteworthy in there, and a bit of a bump up in the short term, more than half of stocks above their 20-day average. There's the VIX starting off really low this week, getting back down to where we were late last year in these high 11s, low 12s. There's the dollar climbing back, holding ground above 103, typically negative for stocks. Hasn't really affected them so much yet. Shipping rates still holding up, along with uranium, one of the best performing commodities. International stock indices going a bit sideways to start this week off. Bit of a sharp move down in discretionary versus staple stocks. Over to stock sectors, worst performing sector today was home builders, followed by retail stocks and regional banks. Best performing sector, another beaten down area I'm following, clean energy. Solar stocks up 3%. PBW up 2.3%. There's a look at the Magnificent 7. Being led today by Meta, still trading up on highs there. And Amazon, Google, Microsoft all doing really well. And Apple bouncing back after it had a really soft start to the year. And we just got Netflix earnings after hours. Actually missed on EPS, down 4.8%, but their membership did come in above expectations, adding 13.1 million new members in the fourth quarter, well above consensus on 8.8 million, and that's what the street's really liking and paying attention to, not just the last quarter earnings per share. There's a look at the 5-minute chart after hours, ripping up almost 8% here. Also doing well today, Verizon just reported earnings, pretty much coming in line as expected, but they did show a bit of a turnaround, adding 450,000 post-paid phone contracts versus the estimate of 260,000, and this is still coming up off its lows where it had been deeply undervalued. Contrasting that, we got 3M down 11% today, after they reported earnings coming in better than expected, after their top line sales fell a little bit from the same quarter last year. And there's a look at the banks still holding ground after they lost a bit after earnings, and JP Morgan, although we do have pretty big bearish divergence there. See whether that plays out or not. There it is, guys, for this Tuesday in the stock market. The S&P just sitting below all-time highs here. Looking at my sector trends table indicator, got a big bounce back up the front. Everything except utilities and home builders back above their 5-day moving average. Still got almost half of them below their 20-day moving average, with the strength still being in anything related to tech, financials, industrials, healthcare, and consumer staples. Tomorrow should be an interesting day with Tesla reporting after close. Make sure you come back for that one. Then going into Thursday, that GDP data and Friday PCE, see how that comes in and the rates market responds to that, and whether the stock market can hold up if it comes in a little hotter than expected. That's all for today. I hope you're enjoying the new charts, and let me know in the comments section if you want to see more technical analysis or more fundamental analysis, and I'll take your feedback on board as I want to keep making this show the best daily markets show on YouTube for all you guys. Thanks very much for your support, and I hope to see you again tomorrow night. Cheers.